Good morning from here in the UK, and welcome to this week's episode of Modesty's Monday Motivation. In this series, we are in episode 11, so it means we've made it through the 11th week since we started this Modesty's Monday Motivation series, where we educate ourselves on everything finance and helping us keep our financial decisions and investments all in check and all on target and all in point. Basically, it's a financial education platform that I've created for my friends, my fans, my audience, and my clients as well, to help us educate ourselves better and hold ourselves accountable as well on all things finance. So welcome to today's episode, and today we're going to be talking about something very, very important and very, very relevant to anyone who is financially alert, or anybody who is interested in anything finance or building a stronger financial future for yourself and for your family. You remember that in the past couple of weeks we have been talking about investment components. We have been basically dissecting investments and picking out some of the components that makes up the whole investment package and breaking them down into very simpler, understandable topics, and making sure that we understand those components. And in that we have talked about inflation, we have talked about leveraging, and last week we talked about risks. So these are all part of the investment components. And today, in continuation with the risk series, we're going to be talking specifically about investment risks. Last week, in the last episode, we talked about risks. We mentioned different types of risks. We talked about morbidity risks, we talked about mortality risks, inflation risk, and investment risk. And then I promised you last week that I was going to focus on investment risk, so that I'll bring a better knowledge of the risks involved in every investment decision you're going to make, and make sure that you are aware of those risks involved and you will know how to navigate them. So today we're going to be focusing on investment risks. But before that, I just want to say a very massive thank you to everyone who joined me in celebrating my birthday on Saturday. It was glorious, it was beautiful, and I'm short of words because the outpouring of love I had from friends and families and well-wishers on that day was just enormous. I wasn't expecting that. Across all my social media platforms, it was just agog with prayers and wishes and birthday wishes and all that, and I felt like a celebrity, so thank you so much for all joining in. And to be honest with you, I haven't been able to catch up with all the greetings. So there are still some people who sent me messages that I have not personally responded to, and to say thank you. Please, if you're in that category and you feel that there is, you feel aggrieved in any way, please just pardon me. There's just so much to get through to, but I promise you I will take my time. No matter how long it takes me, I will get to you and I will say thank you, or I will like your post. I will just to show appreciation. But on a general note, I just want to say thank you very much for celebrating with me, and it's a wonderful one. And I took the children out on Saturday, and with we had the best of times. And then on our way back home, my children said to me, "Daddy, this is one of your best birthdays this is one of your best birthdays that we've ever enjoyed." And I was like, "Really? Is this the best?" They said, "Is there anyone else that was better than this?" I said, "You see, look." I said, "What about my 40th? I mean, we threw a party on my 40th. They said, "Yeah, okay, that's true. Okay, your 40th was good." but this one is really good. And when your children say your birthday was really good, trust me, check your pockets. You must have overspent. So they were giving me a reason to check my pockets on that Saturday to say, look, it looks like I've spent I've spent more than I actually wanted to spend, because the children had lots and lots of fun. So sorry, Ifeoluwa, I'm so sorry if I didn't mention my birthday to you. I am so sorry. Don't worry, no vex. I'll make it up to you. We'll find time to have a proper celebration, and that's why I started with the apology to say, please, if you feel aggrieved in any way, shape, or form that maybe I denied the opportunity of being part of the celebration, I didn't mention it to you, or you wish me happy birthday and I haven't come back to you, please accept my apologies. I will make it up to all of you. There's just so much to get through to. But then, let us just race through today's topic and get ourselves educated, and then we can celebrate. The celebration is still on, so I'm still welcoming all the happy birthdays. I'm still welcoming all the lovely prayers and wishes. You guys are very, very wonderful. Okay, so today we are talking about investment risks. So I just want, last week we defined risk in general, but today I want us to narrow the definition of this risk to as it pertains investments. So basically, investment risk is just the probability or the likelihood of occurrence of losses relative to the expected return on that particular investment. It is a likelihood or the probability of losses occurring in any investment in relation to the expected return. So you can see the two extremes here. There is an expectation, or there's an expected return, but then there is also a probability that that expectation will not be met, or that expected return will not be met. So that probability is the risk component of that investment. So basically, simply put, investment risk here tells you about the measure of the uncertainty of achieving the return that is related to your investment. How you measure the level of uncertainty. So when you talk about investment risk, it simply is saying how unlikely is it that your expectation on this investment will not be met. The variation of that uncertainty tells you how much risk there is in that investment. Therefore, that is where your risk profile now comes in. You now make a decision based on your risk profile, because there has, the level of uncertainty has been measured, and that level of uncertainty is reflected in the level of returns that you are expecting in that particular investment. And that was why last week we clearly mentioned that high returns are usually merged with high risks. Low risks are usually merged with low returns. So the measure of that level of uncertainty is what basically determines how much return is attached to that investment. So if you are going into an investment and it's a very safe investment, there is every possibility that the returns on that investment will be very low. If it's a medium risk, there's every possibility that the returns will be medium. If it's a very high risk investment, there is also a very possibility that the returns are going to be very high. So it is a measure of that uncertainty that basically defines the risk associated with that investment. Now, there is something very, very common that people overlook and people don't really pay attention to when it comes to investments. That thing is called emotion. There is no investment in this world that emotions are not attached to. Trust me, whether you are investing in properties or whether you are investing in stocks and shares or equities or bonds, there is an element of emotional attachment involved in every investment decision that you make. Some people invest in green technologies or in green energies simply because they care about the environment. And that is their emotional attachment. So in that respect, risk is not really their major consideration. Some people invest in special types of properties because they are emotionally attached. They believe that their emotional attachment to that justifies whatever the outcome of that investment is. So emotion is very important consideration, but the measurement of the level of emotional involvement in every investment is a very difficult one for every human being to do, because it's very difficult to know what is going through a human's mind. So for financial consultants and financial advisors like ourselves, if we tell you that we can accurately measure the level of emotional involvement in your decision making in terms of investments, we'll be joking. It's not true. We can't accurately measure it. But what financial advisors and consultants do is that they try to analyze your emotional level through series of questions. And those series of questions are meant to reveal or just give an indication of what your risk profile is, because your risk profile is attached to the level of emotional involvement in your investment decision making. And next week, I'm going to be talking about risk profile in full, because you need to understand where you belong in terms of risk profiling when you make investments, and how financial advisors arrive at saying this is what your risk profile is. And basically your risk profile will just categorize you as either a low risk investor, a medium risk investor, or a high risk investor. You may have known your risk profile. I may not know your risk profile. If you know your risk profile, you can invest along that line. If you do not know, you might depend on the services or the expertise or the knowledge of a financial advisor to help you gauge what your risk profile is, so that you can make decisions along that line. So some people already know, some do not know, but I just want you to be aware that when you make investment decisions, there is an emotional involvement, in that. People go into the stock market, and at the time a certain stock might be, might be the talk of the town. And because they now feel everybody is jumping on this, this is a great opportunity to get into this business, and I'm going to buy these stocks now because it's going to skyrocket in the next couple of years, and I'm going to be. That's emotion talking to you. Now there are two aspects of emotions when we want to interpret them. One aspect is interpreting emotions through perspectives. I want to give you an example. Different perspectives of emotional interpretation. You might see a situation where when you zoom a particular situation in, you will see the details, but you will not see it in context. But when you zoom it out, you will see it in context, and the details will disappear, and the context is the only thing you can see. Let me break it down for you how you will understand it better. For example, stocks and shares. If you are monitoring stocks and shares on a daily basis, you begin to see the movements of prices of stocks and shares. They move up and they move down, they move up and they move down. The perspective you will have at that moment in time of stocks and shares will be that this is a very volatile investment. The prices keep changing every now and then. If you watch Bloomberg and you continue to see the changes in prices of stocks per second, per minute, you come to a conclusion that stocks and shares they are very volatile, they are too volatile. I don't think I can deal with these ups and downs. But then if you pick up a graph of the performance of stocks over a period of time, say 5 years, you realize how the graph moves maybe from low to high. And then you see that over 5 years, those stocks and shares have those price movements brought together, culminated into an upward movement of the graphical line. Therefore, you can conclude that, in the last 5 years, stocks have appreciated in value, and they've given people returns, investors returns in excess of, say, 40%. That becomes the context and the picture within which you've seen it, because you have taken a period of time and you've seen it in that context. But if you compare it to the context, to the perspective of daily viewing of price of stocks and shares, you see it in details of the price movement, but not in the context of the overall performance of the stocks and shares. So your emotional involvement and interpretation at that time are different. When you've seen it over the last 5 years, you will interpret it differently from the way you interpreted it if you saw it on daily basis in details. You know, I went into a shop last week, and then I saw this graph of the performance of gold in the last 5 years. Gold has appreciated by 60% in value in the last 5 years. So that is a typical example of a perspective view of an investment. But if I took my time to be monitoring the price of gold every single day and the way it moves, I will conclude that gold is a very volatile investment. It's a very volatile investment. I might even conclude that it's not for me. But if I see it in the context of performance over a period of time, I might say, oh, hang on a minute, gold has performed, better than ordinary money 60%, 60 times over in the last 5 years. Fantastic. I think this is a very good store of value for me. So you can see how my emotional interpretation of these two scenarios changes because of the perspective I'm seeing them. The reason I'm taking time to break this down for is that when you are making investment decisions, know very well that there is an emotional involvement. There is an emotional attachment to it. And these are the ways that we interpret those emotional involvements. Okay, so let's talk about the different types of investment risks. We're going to talk about 9 different types of investment risks. And I'm going to race through them as quickly as I can. Because remember, we made ourselves promise that we're not going to be taking too long on this series anymore. So I'm going to be breaking them down as quickly as I can. So number 1 investment risk we're going to look at today is market risk. So in the world of investment, there is always a market. So there will be the capital market, there will be the financial, there will be money markets, there will be the property market. There is always a market. So let's say when we look at market risks, this is the risk that is associated with factors that are affecting the market. There are certain events and economic events as well that affect the market. Those events present their own risks to the market. So if you're going into an investment market, the market risk is inherent in any market you enter. Now I'm going to focus on 3 major market risks that I want to bring to your attention. Number 1 is equity risk. If you are investing in the equities market, there is every possibility that the share prices can go up and they can go down. Equities are basically investments in stocks and shares. There is every risk and every possibility that the share prices can go up and they can go down. So it is a risk. You might buy the stock today and tomorrow it crashes. It is a risk. You might buy the stock today and tomorrow it appreciates. It is a risk. I gave an example last week of Debenhams. Mike Ashley lost a lot of money in Debenhams. In fact, he lost everything because Debenhams went into administration. So if there was any shareholder of Debenhams, they would have lost everything as well because the company went into administration. So it's a risk that the company or the shares you've invested in, they could go bust. You could lose everything. They could go into administration. The prices could go up and down on the capital market, because these things are driven by the forces of demand and supply. So the forces of demand and supply applies in every market. Everything you talk about, business and investment, the forces of demand and supply have, as long as it is a free market, the forces of demand and supply would always play its part. The second risk in the market risk category is interest rate risk. Now, this particular type of risk affects mostly bonds or fixed term investments. So bonds operate in such a way that it's a debt instrument. A company or a government issues bonds. They are borrowing money from you in return for a fixed return or a fixed rate of interest. So a company can float a $3 billion $100 bond and say, give us your money, and every year we'll return 5% interest to you on that money. Some of these interests are guaranteed, some are not guaranteed. But for those ones that are not guaranteed, it simply means that the interest rates could change along the lines of market forces. For those that are guaranteed, it just means that it is fixed. Come what may, you're entitled to 5% interest. But then, outside of that interest rate return on the bonds or the investments, right, there are other interests like savings interest rates. Because what it means is that when a company or a government floats bonds, you are comparing the rate of return on those bonds with the rates of return on savings. If there is increase in the rates of interest offered by a savings account, you might say, well, savings accounts are safer forms of investment and they are more liquid because you can easily liquidate them. Therefore, you might decide to put your money in savings and not put them in bonds. So if interest rates rises, the values of bonds decreases, because those bonds, you can actually get rid of those bonds on the capital market, on the floor of the capital market. You can liquidate your bonds, you can sell your bonds to somebody else who will buy them at a discounted rate, depending on how long you've held the bonds for. So if you want to go to the market to offload those bonds and there is drop on interest rates, those bonds may not be attractive. But if interest rates on savings rises, the bonds will remain unattractive. It means that there won't be that much buyers for those bonds because somebody else might be thinking, I'd rather put my money in the savings account because the interest rates are good, and then bonds I'll have to wait for 5 years. I'm not ready to wait for that long. So there is that competition between those two classes of investments or assets, and there is choice. So the increase in interest rate might make the bonds unattractive and the value lower. So it's a risk that you need to be aware of. The third type of risk that I want to talk about under the market risk category is currency risks. Now, this is risk that is associated with foreign exchange. Now, if you are investing in international markets and your investments are denominated in a different currency, there is a currency risk. There is a risk that that currency might drop in value or it might appreciate in value. Say, for instance, you live in the United States and you are investing in the UK capital market, and that investment is denominated in pound sterling. If the pounds grow stronger than the dollars, it then means that the pounds can buy more dollars. So the dollars can buy less pounds. So dollars is weaker and the pounds is stronger. But if the pounds drops in value, it means the dollars, you have dollars that could buy more stocks in the pound denominated investments. Now let me give you a typical example. If, for instance, the pound to a dollar is at $1.40 to a pound, and then all of a sudden it drops to $1.20 to a pound, what it means is that the dollar is getting, just this way. What it means basically is that the pound is weaker compared to the dollar. So if the pound is weaker compared to the dollar, it makes pounds denominated investments more attractive. So you can afford to buy more shares in pound sterling than you already have. But then if you sell that in pound sterling, you'll be able to buy less dollars and repatriate, you'll be able to repatriate more dollars into your dollar account because of the change in foreign exchange policies. So if the currency, if the foreign exchange level drops against your own home currency, that's where the advantage is, because it means you can buy more of those stocks and hold more of those stocks in that foreign currency. For example, if you are in Nigeria and you are investing in pound sterling, and say the dollar to pound, the naira to pound is selling at 500 naira to £1. And then all of a sudden, it drops to 400 naira to a pound. It means the naira has gained against the pound. The pound has dropped in value. So that drop in value in pounds enables you to buy more stocks in pounds, in that pound denominated value. So if you have a £1,000 worth of investments, that investment, if you bring it back home, will now give you 400,000 naira. It simply then means that you get less naira in return. But if naira weakens and goes to 500 naira per pound, and you have £1,000 worth of investments, if you liquidate that investment, what you will get is 500,000 naira. So it means the naira weakening will give you more in your home currency in terms of what you've got. So always compare the currency exchange against your home currency, because that is where you know what the risks are and how the risk affects your investments abroad. So currency risk is part of the risk that is associated with market risk. So in the whole market risk sector, we've got currency risk, we've got interest rate risk, we have got equity risks. Now, the number 2 type of investment risk we want to talk about is liquidity risk. Now, there is liquidity risk if there is an issue with you getting your money out of that investment when you want it. So there are certain investment classes and certain investment types that you cannot get your money very easily and as quickly as you want it. So if you are looking for an investment that offers you liquidity and easy access to funds that are easily liquidated, if you have need for liquidity, you should evaluate every investment along the line of liquidity if you have need for it. There is no point tying your money down for in a long-term investment when you know you have need for money in 2 years' time. For example, you want to move home in 2 years' time, and then you tie your money into a 5-year bond. That is an investment mismatch. There is a liquidity risk there because in 2 years' time, that investment wouldn't have matured. You won't be able to buy the house or move home or buy the car you want to buy or do what you want to do. So if you know that you have need for liquidity in the short term, do not engage your investment in a long term. It will become an investment mismatch. So liquidity risk is a risk in investments. In fact, there are some investments that when you want to liquidate them, you'll be penalized because it goes against the terms and condition. Is that you're penalized by giving you far less than what you have already put into that investment, because that was not the term upon which that investment was set. Or there are some investments that when you want to sell them, you will now have to sell them at a lower price. So you will not get as much as you had expected to get from those investments because you had to sell them below their market value. And if you're selling at a time when the market is low, the risk is even higher because you get far less than what you expected to get from that investment. So liquidity risk is a reality in terms of the risk associated with investment. Bear that in mind when you're making your investment decisions. Number 3 is concentration risk. Now, this is the risk that you bear in mind if your investments are all concentrated on one type of investments or one asset class or one sector. So if everything you have invested is going into equities, stocks and shares, for example, and that is the only type of investment you have, it's a concentration risk in the sense that that is the only asset class you have invested in. There could be other asset classes you could invest in, like properties and bonds and gold, precious metals and all that. So there is a concentration risk there. But then within that concentration risk as well, there could be another concentration risk, because in the equities and stocks, in the stocks and shares that you have invested in, It could be that you only invested in only one market. It could be just the UK stock market you invested in. It's also a concentration risk. And then in that UK stock market, there could also be another concentration risk. So it could be that in the UK stock market, you only invested in the technology sector. So you could see how we begin to narrow the concentration risks down. So if you choose to invest in a particular asset class, say in the equities, in the stocks and shares market, diversification is the name of the game. Yeah, there are people who treat diversification in different forms. To some, diversification in the equities market might mean investing in different markets. They could invest in the Asian market, they could invest in the American stock market, they could invest in the UK stock market, they could invest in emerging markets. So there are different markets that they could put their money. To them, that is diversification. To some other people, diversification might mean sectors. Property sector, technology sector, special sectors like tobacco and all the rest of them. You know, it could be educational sector. There could be sectors of investment that they could just put their eggs in those places. To some, it could be classes. It could be equities and stocks. It could be and bonds and treasury bills and all that spread across different assets. So diversification means different things to different people. But the important thing is that putting your eggs all in one basket is not a good investment decision. However you choose to invest, make sure the risk is spread across different classes of assets, different asset classes. I just wrote on my Facebook last week about my decision to invest in gold, that I've opened a gold savings account. I didn't know that you could actually save in gold, where you open some kind of gold savings account. Rather than saving in normal money, you save it in gold. So every month you set some money aside into that gold savings account. The company uses that money to buy you gold, 100% pure gold, and you can even decide to take delivery of the gold yourself in your house and keep it yourself. Or it could be stored in the vault. The vault is independent of the company managing the gold accounts for you, so which makes it even less riskier for me, because it is not the same company managing the gold account that is managing the vault. The vault management is different, the company managing the account is different. So every month I want to save. Instead of saving in fiat money, I save it in gold, because that's money I'm setting aside for a long-term investment. But then my savings account is for my short-term financial needs. So I have my savings account for short term, because those funds I need in the short term cannot easily be eroded by inflation, because I need them in the short term. But if you want to hedge against inflation, you look for a long-term investment that over time the value will be increasing, and probably will be increasing at the same rate or even exceeding the rate of inflation. So to hedge against inflation, I decided to take a decision to invest and save my funds in gold. And I highly recommend that, because it is a way of diversification. And then you can also now put your investments in other asset classes like properties and stocks and shares and and all that stuff. So liquidity concentration risk is a type of risk that you need to consider when you're making investment decision. Number 4 is credit risk. Credit risk, when it comes to investment, relates to the probability and the possibility that the issuers of the investments or the debt instruments or the investment vehicle could go bust. They may not be able to redeem their promise upon maturity. A government can issue you a government bond, and the government will not be able to redeem that bond when it matures. For example, when Greece had the issues they had, people who bought the Greek bonds were really panicking, because Greece was almost on the verge of collapse. But the European Union came to their rescue, and gradually the economy is returning to normalcy. It could happen. Countries can default on their debt instruments. apart from countries, companies can also do that. Companies can issue you billions of dollars of bonds, and you hold those bonds. Those bonds are only as good as the company's ability to redeem them. That you have those bonds, it can only make sense to you if those bonds are redeemed upon maturity. But there is a risk that upon maturity, the company that issued those bonds and those debt instruments may not be able to redeem them. So you bear that in mind. Now, how do you avert this kind of risk? To avert that kind of risk, when you are evaluating any bond, look at the credit rating of the issuer of that debt instrument, because bonds are the most vulnerable type of asset classes or investments in this type of risk. So, even if you are taking on a country's bond, countries have they have risk assessments done on them, and then they have credit risk assigned to them. So look at the risk profile of that company or that country. They have a credit rating. For example, a country with a AAA credit rating, it shows you that the risk of default is very, very minimal. But then the return on such investments are also very, very small. It's not as high as those that have, maybe double A B or triple B or something like that. So if their credit rating is top notch, the returns on their investments are usually small, because that represents the level of risk you're exposed to. So if you are the risk averse type, that could be the perfect investment type for you. If you are the adventurous type, the returns may not be attractive enough for you. You might be willing to take more risks. So you can decide to go for bonds or debt instruments with higher returns, even though the risks are higher. So number 5 is reinvestment risk. So you see, when you invest in bonds, you are promised returns in terms of interest rates. Some of those returns you can take, and some of those returns you have option of reinvesting them. Those returns will mature, those interests will mature. They might mature annually, they might mature biannually, they might mature quarterly. And when they mature, you have an option to either reinvest them or take the income. So what if you choose to reinvest them? There is also a risk when you choose to reinvest them. That risk is that the interest rates might drop. So what if the interest rate drops? It then means you are reinvesting that money at a lower interest rate. So the returns on that could be lower. Or upon maturity, you will have an option of taking your capital and your income and also to reinvest it. If you have that option and you choose to take that option, what if the interest rate drops? It's also a risk that you've got to consider, because it is possible that upon maturity that interest rate might drop. But if you intend to take your principal and your income upon maturity and to spend it, there is no risk to you. You're not exposed to any risk. But then to avert this kind of risk, what then do you do? Basically, you have an option of shopping around. You do not really have to reinvest it if the conditions are not right. If you have a better investment offer, a better investment opportunity elsewhere where you can put those returns into, by all means do that. And also, when you reinvest your returns on an investment into that particular investment again, what it does is that it increases your level of exposure to that particular investment. So if the percentage of let's say your portfolio, you have allocated 20% to that particular investment, but by the time your income matures and you reinvest it into that same investment, it could shoot your asset allocation to that particular investment up to 25%. It then means that you are exposed now more, up to 25% of your overall asset allocation, up to the tune of 25% on that particular asset. So if your exposure there is now 25%, the question you've got to ask yourself is, in terms of my assets allocation and my investment goals, can I afford to take this much risk on this particular investment, on this particular asset? If that answer is no, what you can do is you can take the income from that particular investment and put it in another investment where the assets, where the allocation has gone down a little bit. Maybe the price or the interest rate on that, the returns on that one has dropped a little bit. It's called asset rebalancing. So you rebalance it again to place your asset allocation on the same level it was prior to that event occurring, because you do not want to expose yourself to more risk than you should take on one particular asset class. That's basically what asset rebalancing is all about. And every genuine investor who is really sophisticated in investment will tell you that asset rebalancing is a necessity when you are investing and when you're making investments. Never allow your exposure, your risk exposure to a particular asset exceed what it should be or what it was prior to you going into that investment. Take it off and rebalance it. Make sure that your exposure across all your asset classes are the same, or they fit the same goal you have set. That's why goal setting in investment is very, very important. Because if you don't know what you want to achieve with those investment classes, you will just leave them to run wild. And when they run wild, they become uncontrollable. Your risk exposure rises with that level of uncontrollability. So asset rebalancing helps you when you are making reinvestment decisions. The other thing you can renegotiate a new deal. You can renegotiate a new deal with the company before you reinvest. See if you can renegotiate a better interest rate or a better deal or better returns, and let them know that you are prepared to walk away if they do not give you, a good deal. It happens. The company might say, well, this investment is important to us, it's significant to us. Yes, we'll give you an extra 1% in return if you reinvest. Then that old deal has come to an end. The new deal kicks in because you've renegotiated. So it's an option and a way you can, avert your reinvestment risk, because what it means is that you have given yourself an extra layer of protection by that extra level of return or income that you've been able to negotiate. Number 6 is inflation risk. Again, this monster rears its head up again. I'm sure this is the 3rd or 4th week running that we are talking about inflation risk. And you see, every time you mention investments, inflation always finds a way of creeping into the discussion. You cannot avoid it. It's a risk and it's a reality. So what is inflation risk? It's simply the risk of your money losing purchasing power over time. So the investment you have put in, the value of that investment could lose purchasing power over time. It means that by the time that investment matures, the value it's giving to you in monetary terms may not be able to buy the same amount of goods or services it was able to buy when you made that investment. So inflation risk is a reality when you are looking at investment risks, because inflation wipes away the value of money over time, which is why there are certain investments that over time have proven to outperform inflation. If your investment income or your investment return does not keep up with the level of inflation, you are losing money. So if inflation in a particular year is 3.5%, and the return on your investment is 3%, you are losing 0.5% on that investment, because your real return is actually minus 0.5%. That is your real return on that investment. If inflation rate is 5% and your investment is giving you 4%, you are losing 1% of your investment, of your return every year. So if your investment value or return does not keep up with inflation, there's a problem. because it means that by the time that investment matures, the value it gives you in monetary terms will not be enough for you. It's not a profit, it's not a return. You practically lost money because the value of that money has depreciated. So asset classes like equities, stocks and shares, they have proven over time, over a longer period of time, to have outperformed inflation. So people who invest in stocks and shares use it as a long-term investment because it has proven over time that it rides out the rate of inflation and it outperforms inflation rates. Another asset class that has proven that is gold. Like I mentioned, in the last 5 years, gold has risen by more than 60%. So I'm talking about inflation rates in the Western economy like the UK. In the last 5 years, inflation has not risen by up to 60% in the UK. So obviously, gold has outperformed inflation in the last 5 years. Another asset class that usually outperforms inflation is properties. The value of properties do appreciate. And the reason properties also outperform inflation sometimes is because the landlords have the right to increase the rents in line with inflation. So when landlords increase their rent in line with inflation, it means they are not losing money because they are making sure that what they are getting in return for the rental value of their property matches the level of inflation increase. And another reason equities or stocks and shares have outperformed inflation is because companies can increase the prices of goods and services in line with inflation. So those companies are not losing money. Therefore, their stock prices are likely to increase because increase in prices could result into increase in profits. And when their profits are good and their dividend payout ratio is good, the stock prices will rise. It means the company is performing very well if they are financially healthy. So if they have built-in mechanisms that will enable them to take advantage of the market conditions and make sure that they are not outperformed by inflation, those asset classes over a longer period of time have proven to outperform inflation. But if you leave your money in cash and in bonds, those two asset classes are most vulnerable to inflation risks because over time, cash loses money. Bonds are fixed term returns. So if you have a fixed term return on bonds for 4%, it means it cannot rise, it cannot increase, it cannot go beyond 4%. So if inflation rises above 4%, your bond investments are losing money. Number 7 is horizon risk. Now, horizon risk simply is the risk you are exposed to that shortens your investment horizon as a result of occurrence of a particular life event. For example, if you lose your job, your investment plans and goals and objectives can come to a quick halt because you cannot keep up with the level of investment you're making. What are you going to do? You might be forced to sell assets. You might be forced to sell some of your investments to at least remain financially afloat, to at least maintain some level of liquidity, to pay bills and do all that stuff. What it does to your investment goals is that it basically shortens your investment horizon. It destroys your investment goals. It just puts you off balance. That singular life event could cost you a lot in terms of your investment plans and your investment goals. You might be involved in an accident, and that accident means you can no longer work. So you didn't basically lose your job because you were sacked, but because you were involved in an accident. And that singular life event could turn the whole thing upside down. And if you are forced to sell your investments at a time when the markets are low, you will lose a lot of money. So what do you do in terms of this kind of risk? Simply insure against every life event that you can insure against. It's as simple as that. If you have an income, take an income protection so that when you lose your job, you do not lose your income. If you don't have an income protection, you are leaving yourself very, very vulnerable, and you are being very exposed to life events. Because when you lose your income, you have lost your major source of income, and you have lost your major assets. Because your assets is simply things that puts money in your pockets. If your income, which puts money in your pocket, disappears, your major asset has disappeared. So if there is any particular asset that puts money in your pocket and you have not taken time to insure against the risk of losing it, you are leaving yourself in the most vulnerable position ever. So horizon risk can be taken care of by simply doing the right thing, ensuring against the risk that will warrant that investment horizon will be shortened. Do not let those life events derail your investment decisions or shorten your investment horizon, because there are risks that you can easily manage through proper protection. When we do mortgages for people, and we always take a holistic view at their protection provisions. What sort of protection have you got in place? Apart from their mortgages, people have come to us to discuss in general terms their protection arrangements, and we look holistically at what protection they have. Life, critical illness, and income protection. These are the very three basic, major, important life protection needs that you must ensure you protect yourself against them. Life insurance, critical illness insurance, and income protection. Make sure you have these three protection in place. If you've got them in place, you've got peace of mind, because then you can carry on doing what you're doing, knowing fully well that the risks that you can't protect, you have already protected. Then if you have other assets like properties, you also protect them. If you've got cars, you also protect. So make sure you protect as much risk as you can insure against. That will go a long way in averting the horizon risk. Number 8 risk is longevity risk. Longevity risk is simply the risk of you outliving your savings or your investments. Now, because people live longer these days, there is the risk of people living longer than the money that they have in place to last them. This risk, people that are most exposed to it are people who are retired or people who are nearing retirement. They are the ones who stand most risk on longevity risk, because they may have planned their retirement that maybe they may say, I don't think I'm going to live beyond the age of 85. And then they find themselves living to the age of 95. 10 years on top of what you planned for. So in that extra 10 years, who's going to look after you? You've run out of money, basically. And in this part of the world, in the UK here, it's a different scenario altogether, where there isn't that much dependence on community. You are always expected to plan for your retirement, and you're always expected to plan for as long as you're going to live here on earth. And to be honest with you, it's not really a very healthy idea to leave yourself dependent on other people to look after you and your welfare. There is dignity in making sure you're prepared for eventualities even till you get to your grave. So if you've made enough and adequate preparation for retirement, and you have asset classes that can give you a lifetime. Some people trade their retirement or their pension for a lifetime annuity. There's something they call annuity. Annuity is basically buying yourself an income, a regular income. So you trade your lump sum pension fund for a regular income for a life. If it's a lifetime annuity, it then means it's for a lifetime. So as long as you live, there's a regular income that's going to be paid to you by the insurance company or the annuity company that sold you the annuity. Some annuities are time-based. You might buy annuity for 30 years. Maybe you retire at the age of 65, and you say, I want to buy annuity for 30 years till I'm 95. You buy annuity, and once you are 95, the annuity stops. So if you live up to 100, you are now on your own for the rest of the 5 years. Some people invest in properties, and they decide to hold up the properties for as long as they live, because the income from properties will feed them and will make sure that they pay their bills from the income of that property for the rest of their lives. There is also risk in that, because there is no guarantee that the tenant in that property is going to be paying rent as and when due. What if the tenant doesn't pay? What if the income doesn't come in? What if the property has major structural issues? That means you have to put in more money to repair it and to put it in place, and then it's costing you more money. There's also risk in all that. But the important thing is to diversify your investments and have different asset classes that can yield you things at different stages of your retirement. Get something that can arrange for income, maybe on a lifetime basis, something that can give you an income up to a certain period. Just make sure that there is enough spread of assets in your investment or your portfolio that will take care of every stage of your life and your life development up until your. So longevity risk is a risk that if you don't want to suffer it, you start preparing for it. And the best way to start preparing for it is start thinking about retirement. What have I got in place for retirement? We have done a session here on pensions and retirement. So if you go to my Facebook page and search for the previous sessions we've done, you can go through what we've talked about pensions and retirement planning and see how much knowledge and information you can grab yourself there. So it's very important you also put that into consideration. Finally, number 9 on investment risk is foreign investment risk. Foreign investment risk, this is a very important one. Foreign investment risk basically is if you are investing abroad, and when I say abroad, outside of the shores of where you are based. So if you are, for example, based in the US and you want to invest in the UK, you are exposed to foreign investment risk because government policies do change. For example, the UK is going into a general election on the 12th of December. That's this Thursday. And the two major parties, have different proposals for investment, for the economy, and for management of the finances of this country. And I bet you a lot of foreign investors are on the edges of their seats watching what's going to happen. Now I'm going to tell you an example of what's possibly going to happen in terms of foreign investment risk. The government of that country might decide to nationalize certain sectors and investments. What if you've got interest or stake in those sectors that that government wants to nationalize? It's a risk that your investment could be wiped off and taken over by the government, and the government might even decide not to compensate you for that. They've nationalized it. If they want to compensate you, it's because it's their policy. It's nationalized. It becomes a government property, and then investors will have to look elsewhere to invest. And funny enough, one of the parties here, Labour Party, led by Jeremy Corbyn, this is one of their proposals. They are saying that if they win the election, they are going to nationalize the rail services, they will nationalize water, they will nationalize the energy sector, they will nationalize, the NHS is already nationalized, the health sector is already nationalized, although there are certain levels of private investment in it. But then they are also going to nationalize parts of the broadband. And they promise to give every single household and business in the UK free broadband. Now, BT, British Telecom, are one of the major stakeholders in the broadband business in this country. Their facilities are being used by all of the individual broadband providers in this country. So, and the government, Labour government said that they're going to nationalize parts of the British Telecom facilities and make it a government property. Now, BT have got investors, they've got stakeholders, they've got shareholders. And then think about other broadband providers who have invested heavily into equipment, into facilities, into infrastructures to make it competitive. So there is competition. And there are choices for users, for broadband users, to choose who they want to be their provider. If that nationalization happens, those other companies are simply going to disappear. Because, if the government is going to provide you free broadband, why would you go and pay for broadband anywhere else? So it's basically just going to disappear. So that is the risk. And then imagine people who are investors who invested in the rail services and the rail sector, and they are hearing that the government says if they win the election, the Labour government is going to nationalize the rail services. They will be jittery. So it's a panic time for investors in some of those areas in the UK that the Labour government promised to nationalize if they win the election. It's not good news to investors. So they are really, really panicky and watching closely how the election goes in the UK on the 12th of December. So that's an example. If you're an international investor and you have a foreign investment anywhere, any occurrence politically or economically in that country is likely going to have an impact on your investments. So be aware of that when you are investing abroad, that it is something that you have to be ready to take, either take advantage of it or put measures in place to minimize, the risk. Some people might decide to even sell their foreign investment stakes at the slightest hint of uncertainty. For example, Brexit is a high degree uncertainty now in the UK. And some companies are already moving their headquarters away from the UK to other countries because they cannot stand the uncertainty, and it's killing their businesses, it's killing them. They don't know where it's going. So the risk is too high for them to be. They've just decided to move out. That's the way they choose to react. Some other investors have chosen to sit back and see how it all plays out and how it all pans out after the general election. So those are risks that are inherent in foreign investments if you're a foreign investor. So in summary, I just want to lay that different investments come with different levels and degrees of risks. Risks are not the same across all sorts and types of investments, especially with different stages of your investment life or your investment journey. You would incur different levels of risks at different levels and at different stages. But it's very important that you have an idea of the level of risks that is involved in that investment before you get involved in it. And that is what this episode is all about. It's all about educating you on the different types of risks that are inherent in the investment decisions you are going to make. If you have an idea of those risks, then when you are making investment decisions, it makes it easier for you to analyze that investment and find out how you are going to react to those risks and how you are going to prepare yourself for those risks, or how you are going to avert or minimize the impact of those risks on your investments and on your returns. So when you are going into an investment, you have an expected return. The possibility that that expected return will not be met is there. That is the risk. If you emotionally go into an investment without proper analysis and you just go in because of emotions, it's a very risky step to make. Make appropriate research and prepare yourself for the risks that are involved, so that when those risks occur, you are not caught out and you don't, you don't feel like the whole world has come crashing on you. Preparation is everything. But be rest assured that if you go into an investment thinking that it is completely 100% risk-free, no. The only risk-free investment in this world is the one you never made. That's the only risk-free investments. So folks, thank you so much for being part of today's episode, and I hope you've enjoyed that, and I hope you've learned something from that. But I just want to recap the 9 investment risks that we have talked about today. Number 1, we talked about market risks. And in market risk, we said there is equity risk, there is interest rate risk, and there are currency risks involved in the market risk. Number 2, we talked about liquidity risk. And number 3, we talked about concentration risk, which is the risk of having all your investments in one type of investment. Your liquidity risk is the risk of not being able to get your money out when you want it. Concentration risk we've talked about. Number 4, we talked about credit risk. It is the risk of companies or countries not being able to redeem the promises they have made based on the debt instruments or the exchange of contracts between you and them. Number 5, we talked about reinvestment risk. Simply means that when you reinvest, there is a risk that the returns on that investment could have dropped by the time you are reinvesting either the income or the capital. Number 6, we talked about inflation risk. Inflation risk is simply the risk of loss of value of your money over time. If your investment does not keep up with the rate of inflation, there is a very high risk that inflation would have wiped up the value of your investments. Number 7, we talked about horizon risk. Horizon risk is the risk of your investment dreams and goals and objectives and your horizon being shattered as a result of life events occurring, which means you may have to sell off some investments. And we said, make sure you protect yourself against every foreseeable risk as much as possible. Number 8 is longevity risk. Longevity risk is simply the risk of you outliving your income. If you outlive your income, there is a risk of you living the rest of your life without any type of income. So preparation, we said, is everything. Number 9 is foreign investment risk, meaning that if you're a foreign investor, you're investing abroad, be aware that the country you are investing in, the economy and the economic and the political events in that country could well impact in your investments there. Your investment could completely disappear, or it could favor you, positively. And on foreign investment risk, I was having a chat with a friend who contacted me and said, please, is there any possibility of getting investors into the real estate economy sector in Nigeria? And I said, well, from the UK here, I do not think it's a viable one for anybody who wants to go into the real estate sector in Nigeria because of the risks involved in it. The real estate sector in the UK is stronger than the real estate sector in Nigeria. So it would be a difficult task for me to convince anybody to go to Nigeria and invest in real estate sector. And he wanted to know the type of risk I was referring to. And I said political and economic risks. He said, no, it's a private investment. Political risks are not, are not really realistic in private investment. And I said, I have heard stories of the government just waking up one morning in Nigeria and they are bulldozing people's houses. And they will tell you don't have a C of O, or you are building on the wrong place, or your documents are not correct, or the government have decided to take over this particular place, so we want to demolish everything here. It's a risk, and it's happened to some real estate investors in Nigeria. So if somebody has pumped in so much money into that real estate sector, and the government wakes up one morning and say, oh, this real estate is on a waterway, we want to demolish it, it's a risk. But if you invest in real estate here in the UK, for example, and you get your documents from the government saying this is your home, that remains your home for hundreds of years. If the government wants to take that house down, they will have to buy that house at the current market value and pay you handsomely for that, because that is your contract with them. So investments abroad come with its own political and economic risks, and you've got to be aware of that as well before you make investments abroad. But that does not mean that real investment or real estate investment in Nigeria is completely and utterly to be avoided. There are people who are making a very good living out of that. But all I am saying is that the risk is too high for somebody to come in from the UK and do it in Nigeria compared to what they can do here, because it's safer to invest it here than invest it in Nigeria because of the risk inherent in that. But if you do it in Nigeria, you're making good money out of it, and you can bear the risk. That's absolutely fantastic. Crack on, go on with that. But I'm just analyzing the risk aspect of that. So God bless you, and do have a wonderful day. And next week we're going to be talking about your risk profile, and we'll see how your risk profile is assessed and how it's analyzed. Take care and God bless. Bye now.